hard to believe that 2020 is upon us. And I wonder, Jeff, what's your bull case? What's your bear case? As we've been discussing, it's been quite a long bull run.
Bear case is certainly that we're going to go into a recession in 2020. I think a lot of that may be to the lagged effects of Fed tightening. So when the Fed tightens or cuts rates, it usually takes about 12 to 18 months for that to filter through into economic activity. It's a key reason why the Fed never gets a recession right, because when they start to see the data deteriorating, they may cut rates, but that's not going to be a quick enough turnaround to save the actual economy. And if you look at manufacturing PMI, when it's decelerated and you've had Fed tightening, on average, it's bottomed out at a 40.5 level. And the most recent manufacturing print that we got was a 48, which means that there's going to be more slowness in that sector. And we think that there's going to be a recession scare sometime in the first quarter. Also, if you look at profit margins, broadly speaking, for the U.S. economy, we look at NIPA profit margins. They were revised down by $200 billion in July, which is a huge revision outside of a recession. And it's disproportionately hurt small and micro cap businesses. So if those businesses are starting to feel those pain, maybe they start to cut back the hours of their employees. And when that doesn't maintain their margins, eventually they'll lead to layoffs and a recession will ensue. But the bull case is the one that the markets are clearly pricing in at this point, that the Fed and global central banks have engineered a soft landing similar to 1995, and investors are not positioned to be taking advantage of this. So if you look at flows over the course of this year, about $850 billion is going into bond and money market funds, and $200 billion has come out of global equity funds. The net difference between the two is over $1 trillion, which is the largest on record. So I believe if a soft landing is successfully engineered, that you'll have a little bit of FOMO or fear of missing out, that money will make its way back into the equity markets, and it will have a really good year in 2020. Also, I think you could get some valuation expansion from here. So if you look at every bull market top going back to 1946, heading into a recession, there's been 11 of them. On average, the trailing PE multiple has been 27% higher or at a premium versus its previous 5 years. And today, the PE level of the market is actually at a discount versus the last 5 years. So I do believe we could get a little bit of multiple expansion. And just to get to that 27% premium level, that would be PE multiples go up about 5 or 6 turns. So the bull case is really that this soft landing is successfully engineered, flows come back into equity markets, and you get multiple expansion.
And I wonder, you mentioned the inflows into bonds, for example. What do you make of the price of gold that we've seen rising in 2019? How does that fit into your bull case, bear case?
I think it's just a sign that the Fed has cut rates. They've given us an opportunity for economic growth to reaccelerate, for inflation to accelerate from here. And gold is going to be the natural beneficiary of that trade. It's interesting if you look at a chart of gold overlaid with the amount of negative interest rate bonds in the world. Over the last 5 years, they're mirror images of one another. So if you continue to see more and more bonds globally trade at a negative interest rate, I would think that would be bullish for the price of gold. I do think that the U.S. probably has enough ammunition to get through the next recession, right? If you cut rates to zero, it's about 175 basis points from here. If you look at the last 7 recessions, on average, it's taken them about 7.5 percentage points of cuts to get you through that rough patch. They can bring back QE. The balance sheet of the Fed is about 1/5 the size of the Japanese. It's less than half the size of what you have over in Europe. So they certainly will bring back QE with steroids. You could bring into the fray forward guidance, where they may say we're not going to raise rates for 1 or 2 years, which will help ease financial conditions. But after you run out of those 3 policy choices, even though policymakers have said that they wouldn't do negative interest rates because of a lot of the things that were mentioned previously, negative interest rate policy, where the regions that it was instituted did a very good job of depreciating the currency in that region. So when you run out of monetary bullets, I think that would be a topic of discussion if it's one of these more deeper recessions. But given the lack of excesses that we see right now, I think the next recession is probably going to be a shallow one, economically speaking.
Anyone else have thoughts on the Fed's inflation target? Or
there's been some chatter from the Fed that they're going to move to an average inflation targeting regime, an average of 2%. So since they've undershot for roughly the last 10 years, in fact, over the last 10 years, there's only been 6 months of that time frame where they were above their 2% core PCE target. If they move to an average of 2% inflation target, that would allow inflation to overshoot as you get later in the economic cycle. And if they do that, obviously I think that's going to help boost inflation expectations, that the Fed is a little bit more committed to generating inflation and going to be a little bit more looser from a monetary policy perspective.
Does anyone have thoughts on what could make the Fed change course?
I do. I think that if you do have a genuine recession scare, which again was our base case in the first or second quarter of next year, that the Fed will give an insurance cut or 2 more than what they've had already. So our expectation is you're going to get at least another cut sometime in the beginning part of that year. But it's going to have to be predicated on a deterioration of the data a lot further than what we've seen here recently.
And what do you make of consumer strength, consumer demand right now?
One thing I'll mention about the consumer is that it's a source of strength in our recession risk dashboard that we have at ClearBridge. A group of 12 variables that have done an excellent job of being able to foreshadow an upcoming recession. And right now, it's a 50-50 probability of a recession. And if you think about each one of those variables, green is good, yellow is caution, and red is bad. And right now, we have 6 green, 3 yellow, and 3 red signals. But most importantly, the overall dashboard is flashing a yellow signal. But if you look underneath the surface, all 4 of the consumer variables are green. And I firmly believe that they are going to hold the fate of this economic cycle. And if they can continue spending and they don't retrench, this will be a slowdown like 1995 or 1998. But if they do start to get a little bit more worried about the labor market, start to pull back their spending because of an escalation of trade wars, that ultimately would sow the seeds for recession next year. Now, if you look at the dashboard over history, it's done a really good job of being able to identify a recession, but there's a key difference between a red signal and a yellow signal. So the dashboard has had 8 red signals in its history, going back to 1960. 7 out of 8 of those were recessionary, so it's a much more powerful signal. You've had 3 periods where the dashboard turned yellow. Something happened and economic growth reaccelerated and it went back to green. Those false positives were 1995, 98, and then 2016. Now, ultimately, we think all of those would have been a recession, but the Fed recognized weakness in each one of those instances, gave liquidity to the markets, and caused the economy to reaccelerate. So if you think about the point of where we are today, the Fed has clearly gotten the message. They've cut rates 3 times. They're doing quantitative easing, and we can debate whether it's quantitative easing or not, but it does provide liquidity to the system. But it does give us a fighting shot of avoiding a recession next year. The one thing I really want to hammer home here is that usually when you've had a yellow signal in the dashboard, between the 6 and 9 month time frame of it turning yellow, usually the data accelerates or decelerates, and we turned yellow in July of this year, which makes the first quarter of 2020 the make or break moment for this cycle.
Any other economic indicators that you're especially watching right now?
One thing I'll just throw out there is that on the dashboard, one of the indicators is jobless claims. Whenever you see a year-over-year rise in jobless claims of 12%, it's always been recessionary, and you've always been 3 months away from that recession. So it has a very high hit rate and has a very high degree of precision of telling you when that recession is coming. If you look at jobless claims, we've been in a range between 210,000 per week all the way up to 240. And the most recent couple of weeks of jobless claims, we've gone right back to the bottom of that range, which is a good sign that we're not on the doorstep of a recession quite yet. But if you do start to see that turn to yellow and eventually red, the alarm bells will be going off at ClearBridge that the economic cycle's over. One of the things that we're concerned with now is that credit spreads may not have the information value that they've traditionally had in previous cycles because of negative interest rate policies that are pursued by regions like Japan and Europe. The reason why we say that is if you look at the fourth quarter sell-off of last year, equities actually led that sell-off by about a week, and spreads started to blow out afterwards. And we think because of this thirst for yield, that may be distorting the amount of lead time that you get from spreads. But to your point, there are areas like triple C's, lending standards that are starting to tighten up that could be signaling the canaries of the coal mine this time around.
And talking about headwinds and tailwinds, there's been a lot of focus on the global slowdown, and I wonder what's happening and what's your outlook for the U.S.?
One of our saving graces, though, to your point, if margins are going to continue to deteriorate, is if you look at the NFIB survey, which is the premier small business survey. One of the biggest issues facing small business owners is finding qualified labor. So they may hold on to that marginal employee much longer than they traditionally would, even in light of margin deterioration, because if you let that employee go, if economic growth reaccelerates, you're going to have a very hard time filling that role. But that could be one kind of silver lining that could keep us going in and get us through this slow patch. One thing I'll say about political risks is I do believe that will keep business uncertainty high, right? The trade wars, even if you get a truce, depending on how that truce plays out, if tariffs can come back into the fray immediately, that keeps that uncertainty. Obviously, we don't know who the Democratic nominee is and what the implications are on the market. So I don't think business confidence is coming back. But if you look at the last 20 presidential election cycles, the year leading up to that presidential election, the markets have been positive 18 out of 20 times. So you have a hit rate of about 90%, and your average one-year return has been 9.7%. So the market does a really good job of not sifting through the political noise and focusing on the economy. Traditionally, you'll see the market move about 6 months prior to the actual election. Markets don't hate bad news. They don't hate good news. They just hate uncertainty.
Yes.
But right now, I think the base case of it's being priced into the markets right now is for a split Congress, which would be best case scenario.
And in closing, I want to get your final thoughts on where we're headed. We've talked a lot about uncertainties, geopolitics, the upcoming election. Jeff, I'm going to start with you. What do you think the key opportunities and risks are moving forward?
I think we've covered the risks pretty good in the panel here. Obviously, trade wars continuing to escalate, that we don't get a truce next week. And you do start to see that affect consumer confidence, business confidence, and ultimately causes a recession. One of the reasons why we are pretty optimistic about trade is that if you look at every post-World War II president that went for re-election, there was only 3 that didn't get reelected: H.W. Bush, Carter, and Ford. Those were the only 3 presidents that had a recession within 2 years of the election. And they're the only 3 presidents that had a material rise of the unemployment rate the year of the election. So I think the Trump administration is quite aware of that trend, and I think that does bring them to the table and at least not necessarily get a comprehensive deal, but at least have a trade truce and not have the escalate further from here. From an opportunity standpoint, though, we do believe that biopharmaceutical and healthcare, broadly speaking, looks attractive. Earnings revisions have been very positive in that group. They've held up really well. But also, if you look at biopharmaceuticals specifically, there was only 2 times since the 1990s where biopharma traded at a cheaper valuation than the overall market. That was the early 1990s with Hillary Care, and it was at the 2008 when Obamacare was coming out. Political risks were clouding the sector, but once you got through those tough periods, biopharmaceutical re-rated higher. And I think we will likely see that situation as we make it through the upcoming election cycle.